Good day, everyone. Welcome to our webinar for May month. It's been quite an eventful month, although there have been a lot of public holidays. I'd like to, as usual, start off by looking at the American economy, and particularly the S&P, which is where we usually begin. And I thought I'd just go back a little bit in history and look at it over the long term. As you can see here on the screen, I've put the entire bull market on the screen, starting with right down in this bottom left-hand corner, the point at which the great bull market began, which was literally on the 6th of March 2009, when the S&P 500 made a low at 666. And then, of course, it's gone up, and there have been various corrections, and I've identified these corrections for you. This is the 2010 correction, which you may recall was all to do with the Greek crisis in Europe, and it took the market down 16% over a period of months. Then we had a 19.4% correction in 2011, December 2011, and then there was a long upward trend, followed by a correction here in 2015-16, and then finally now this correction here, which was obviously caused by Donald Trump to a large extent with his trade war with China, and also other things that he said, especially over the Christmas period, which resulted in a V bottom, which is quite unusual for a correction on the S&P 500, as you can see. But that was really because he made these comments over the Christmas period when most investors were out of the market, and once they came back, of course, they bought the market up. But as you can see now, we're at a new all-time record high here, over to 2943 is the new high, and that was yesterday's closing position. So if we focus in on that correction, just the last one, here you can see it in more detail. I'm going to go to a candlestick chart, and you can see the V bottom that was caused by Trump's remarks very clearly there. And you can see that the correction from this high point here, 2930, which was made on the 20th of September 2018, it's run about 7 months. And we're at a new record high now of 2943. Now, of course, the bear trend, the great bear trend that we've been looking at, was caused by the subprime crisis. So if we just go back here and quickly look again, the subprime crisis, which commenced really in 2007, and you can see here, it stopped the upward trend here. This is 2015. Sorry, this is 2008 though. And the market only started to fall in 2008, from about the middle of 2008. Of course, there were great events like the collapse of Lehman Brothers, and that caused this downward trend. And then there was, of course, a massive response from central banks around the world, led by the American Federal Reserve. And that took the form of quantitative easing, which saw more than $12 trillion injected into the world economy. And in fact, Europe is still injecting funds into its economy, doing quantitative easing. Okay, let's go back then to the 6-month picture and back into our candlestick chart. And here you can see we're ramping up very nicely. And the market is at a new record high, which is what we always predicted it would be. We always said that this correction was just that, a correction, right? We never saw this as a new bear trend. And we said that right from the beginning. This is just a correction, therefore probably a buying opportunity as far as investors are concerned. Now we've broken to a new record high, so it's quite clear that it was a correction. And now the question is, where will it go from here? Okay, so one of the things that drives the S&P 500, in fact, the main thing that drives the S&P 500 is the quarterly reports that come out for the S&P 500 companies. So these companies are very big companies, they're massive, and the quarterly reports have been very good. They've been beating expectations, because in America there are lots of experts who predict what the quarterlies will be and whether they'll be at this level or that level. And in this particular quarter, the first quarter of the year, we've had about 140 of the S&P 500 companies that have reported, and 78% of those reporting so far have beaten expectations. So that's amazing. Nearly 80% of all companies reporting have beaten the expectations of analysts. The only real negative here has been the oil price. And the oil price has been a problem because, as you will see from this chart, and I'll look at it in more detail later, the oil price has been trending up for most of this year. So we're now at about $71 a barrel. A little while ago it was at 74. So this obviously has a widespread effect on everything. In February month, and of course nothing is ever always altogether positive, right? So in February month we had some negative news out because the February month's retail sales in America were predicted to be up by 0.3%, but in fact were down by 0.2%. So that's just for that month of February. And that just shows you that nothing in the market moves in a straight line. There were no tax cuts this year in America, no more Trump tax cuts, so that obviously depressed consumer spending a little bit. And don't forget that in the same announcement, they revised the January retail sales up from 0.2% to 0.7%. So these figures are not always reliable, and you need to wait a few months to see what actually comes out of the woodwork. Over the year to February, over that entire year, the growth was 2.2% in retail sales. So there are always negatives in the marketplace, and there are always bears. The bears are always around. They're always out there. They're always saying, okay, now we've had a bull market for 10 years now, so we should expect this to be the end of the bull market, because we haven't had a bull market for longer than 10 years since the Second World War. The length of time that this bull market has been going on is in itself a record. So therefore, we're at the top of the market. But I put it to you that is a very simplistic logic. And in our view, we have always maintained that this is a long-term bull trend, that it will exceed all other bull trends, and it will go up to record levels. And that's exactly what it's been doing. So, of course, Morgan Stanley has a thing called the recession dashboard. Morgan Stanley, a big American financial services company. And 2 weeks ago, their recession dashboard produced the strongest indication yet that American economy was going into a recession. And then shortly after that, the S&P 500 broke to a new record high. And this is what I call the elimination of the bears, because Morgan Stanley is obviously now discredited. Their recession dashboard has been discredited. The market doesn't care about it. And the share market is going up and up. And what's happening is, in the process, bears are being eliminated. And that is a classic sign of a bull trend. In any bull trend, you'll see that as it goes higher and higher, you'll get one bear after another standing up and saying, this is the top of the market, you should sell out now. And then a few months later, when the market's made a series of new record highs, that person is discredited, relegated to the scrap heap, and yet there's another person that now stands up and says, yes, but now this is definitely the top of the market. And so you go on, eliminating the bears one at a time, until eventually nobody is willing to stand up and say this is the top of the market. And that point, of course, probably is the top of the market. When you see that, it's a definite sign that we're very close to the top. So if nobody is bearish, that is a very scary sign indeed. Okay, let's move on then to the South African economy. Of course, and I want to just talk a little bit about the political situation, because we're just 1 week away from that election, which we've all been anticipating. And in this regard, I'd like to just spend a little bit of time to say that investors shouldn't worry about what should happen. Don't think about what should happen. Worry about what will happen. Because investments are not affected by what should happen. They are affected by what will happen, what does happen. So, in our view, it seems pretty clear now that the ANC will win 60% of the vote. The latest polls are indicating that, and I think that's probably what's going to happen. And that will be a very strong mandate for Cyril Ramaphosa. And it's interesting that things like the load shedding that we saw about a month ago, and also all the revelations of corruption which have come out of the various commissions that are sitting, and which implicate members of the ANC, even quite senior members of the ANC, do not seem to have dented the ANC's popularity. Cyril Ramaphosa himself seems to be very popular with South Africans right across the board. So we think that the election will be won by the ANC with quite a resounding margin. So what we need to do now is to think about what will happen after the election, because that's actually what matters. The first problem, of course, that they will have to deal with, and very quickly, is Eskom. Eskom, of course, has two problems. One is power generation. They've got to keep the lights on. We can't deal with more load shedding. And the second one is a huge financial problem. And they're going to have to deal with that sooner or later. And as soon as the election is over, I think they will be ready to take the relatively unpopular measures necessary to make Eskom a viable operation. At the moment, it's not viable. The accountants would say it's not a going concern, and they would be quite right. So we need to take the steps that will make Eskom viable and a going concern without pushing the electricity price up to such an extent that we cripple the economy. And there are many options here, one of them being, of course, to open the doors to renewable energy, to change the legislation so that renewable energy providers can add their contribution to the grid. And then the second big problem that the ANC will have once they've won the election, or that Cyril Ramaphosa will have, will be to deal with the deep, systematic problems in the South African economy. And we see those as threefold. First of all, the civil service. The civil service in this country is about twice as big as it should be. So they're going to need to chop that civil service in half. And that can be a very delicate issue, very difficult to do. Then, of course, there are the state-owned enterprises. In our view, these have to be privatized wherever possible. So we're running all sorts of state-owned enterprises that we do not need and that should not be run by a government. Those state-owned enterprises should be sold or shut down, one of the two, to simplify and reduce the size of the government. And then the third thing, of course, is that they need to make the labor legislation in this country more employer-friendly. At the moment, the labor legislation is skewed in favor of the employee. And it's actually very difficult for employers to manage their employees as a result. So employers don't employ people, because once you employ somebody, it's almost impossible to get rid of them with the current legislation, and very expensive. Of course, all of these three measures, cutting the civil service, privatizing the SOEs, and changing the labor legislation, are bound to result in a confrontation with the unions in this country. And we see that as inevitable. The question really is, will Cyril Ramaphosa's mandate be strong enough to give him the power to be able to do that? He's certainly been steering away from it until the election. I mean, we saw what he did with the Eskom pay rise. I mean, he just immediately gave them whatever pay rise they wanted to avert a crisis before this election. But I think after the election it will be different. There is, of course, also the issue of the nationalization of the Reserve Bank. We regard this as merely a sop which is being thrown to voters. It doesn't change anything. It's a completely pointless activity. It will result in a cost to the Reserve Bank, depending on how it's valued, somewhere between 20 and 100 billion rand, which we think is completely unnecessary. But it's a sop that is being thrown to voters by the ANC. Of course, our economy is very dependent on effective tax collection, like any economy. We have to collect tax, otherwise there's no money to do things which are for the collective good, like building roads and having a police force and so on. And throughout Africa, the problem that African countries have had is that they have been very bad at tax collections. They've allowed their expenses to run away, and their tax collections have become moribund, with the result that they've had a huge shortfall. At first, they borrow money to make up that shortfall, but sooner or later they end up printing money, and that has the inevitable consequences. And so you end up with a Zimbabwe-type situation where the currency collapses completely, and Zimbabwe at the moment is paying the price of that collapse. So we don't want that in South Africa, and we haven't had it. In fact, inflation has been very well controlled in this country since the ANC took over, and I'll talk more about that in due course. The consumer price index came in at 4.5% in March, and that's up from 4.1%. So it's now at the exact mid-range of the target, which is between 3 and 6%. And the Reserve Bank has said that it wants to keep that inflation rate at roughly that midpoint. But of course, SARS, the South African Revenue Service, reported that it was 57.4 billion rand short of the amount it was supposed to have raised in terms of the February budget. So that's a huge concern. And what's even more concerning about that is that 1/3 of that, roughly 20 billion rand of tax, more than 1/3 actually, was lost through the cigarette black market in this country. And that was due to the fact that the specialized unit within SARS that was dealing with this was shut down by Tom Moyani for some reason when he was the head of SARS. And of course, it's going to take us a few years to get back to the previous efficiency that we had at SARS. At the same time, there are enormous demands on the fiscus. The fiscus is having to finance Eskom. The other day it had to put in 5 billion rand just to enable them to pay salaries. They've got this problem of needing approximately 250 billion rand, and the Treasury is already injecting emergency funds. Apparently the diesel generators have already cost us about 50 billion rand in a desperate effort to keep the lights on until the election. So far they have managed to keep the lights on, and probably they will succeed, but the cost hasn't yet been paid. A couple of other points on the economy, well, one in particular, is that this National Credit Amendment Bill, all it needs now is Cyril Ramaphosa's signature and it becomes law. In terms of this bill, the regulator can write off anybody's debts up to 50,000 rand if they earn less than 7,500 a month. So anyone who earns less than 7,500 rand a month can apply to the regulator, and he, at his own discretion, can simply put a pen through their debts. So obviously lenders like banks and other people who offer credit are very unhappy about this situation. And their reaction is typical. They will simply not lend to anyone who doesn't earn at least 7,500 rand a month, because there's a possibility that the regulator might eliminate what is owed to them. That might be done though. That piece of paper might be signed by Cyril Ramaphosa in an effort to win support in this election. I really hope he doesn't do that, because that would be a totally political move. All right, let's look at the rand now. The rand is always very important in any South African investor's analysis of the markets. And I want again to go back a little bit in history here. I think, from my perspective, one of the greatest achievements of the ANC since it gained power about 25 years ago has been to keep inflation under control. Most of this chart that you see on your screen now goes back to 1997, and for a large portion of this period, Trevor Manuel was the Minister of Finance, and he kept a very tight rein on things. During that time, we had two massive risk-off events. which affected South Africa. Both of them came from outside South Africa. The first one was the 9/11 attack on the World Trade Center in New York, and that caused the rand to spike, as you can see here, very badly. Emerging currencies generally did badly, but the rand, being so liquid, was particularly badly hammered. But Trevor Manuel clawed it back from that level all the way back down here. And then, of course, we had the subprime crisis in 2008, and once again, our currency was hammered by international currency speculators because it's so well traded, it's so liquid, and it took us again time to claw back from that level towards more reasonable levels of the rand against the dollar. That, of course, was followed by the Zuma period. And here you can see how the rand weakened steadily during the Zuma period, all this time, until finally Zuma was forced to appoint Pravin Gordhan as the Minister of Finance. From that moment, the rand started to strengthen, because, of course, Zuma didn't want to have Pravin Gordhan as the Minister of Finance, but he was forced. His hand was forced, basically. And people saw that as a weakness in him and the beginning of the end for him, and they were quite correct. And so they started buying up the rand again, and the rand started to strengthen. Then we had emerging market instability over here, particularly Turkey and Brazil. Nothing again to do with South Africa, but it impacted the rand because the rand is the most heavily traded emerging market currency. So anything that happens that's negative in the emerging markets tends to impact on the rand directly. So we had immediate weakness in the rand. We are now recovering from that and moving forward and down again. As you can see, the rand is strengthening again, and we believe that trend will tend to continue. In other words, that the strength will tend to continue unless there's something radical and unexpected. Of course, as we approach the election, we can expect volatility in the rand. That is only reasonable. But the fact that it has not gone, that it's stuck around the mid-14 rand to the US dollar level, is a good sign in our view. It means that most international investors believe that South Africa will recover from its current difficulties. And of course, this is confirmed by the R186, which is also very heavily traded internationally. Overseas investors do like this bond. So this is our long bond. And you can see here that this bond, the interest rate on this bond has been trending stronger. So when interest rates go down on bonds, on government bonds, it is an indication of confidence in the economy. When international investors don't have confidence in South Africa, then this interest rate will go up. But as you can see, the yield on the long bond has been trending down, and it's now down here at 8.5%. But a little while ago, just in October last year, it was at 9.36%. Now we're at 8.5%. And of course, the people who are buying this bond have got literally billions of US dollars on the line. They have to be right. They can't afford to make a mistake. They're attracted to our bonds because obviously the interest rate is much higher for them here than it would be, for example, in US T-bills, where the interest rate is around 3%. So they're making 5.5% more than they would make on their US T-bills. And that is the cost of the risk of investing in South Africa. But what I'm saying is that the strengthening of that yield confirms what I've said about the rand. International investors believe that this election will be peaceful and that the ANC will, as I've suggested, win about 60%, giving Cyril Ramaphosa a fantastic mandate to do the deeper reforms which the South African economy so desperately needs. All right, now I'd like to just talk a little bit about commodities. I don't know if you've been reading my articles and so on, but you know that I've been following the story where AMCU has been on strike at the gold mines at Sibanye. That strike has now been resolved, as I expected it would be. AMCU basically threw in the towel. They realized that they'd made a mistake, and they've resolved under what I can only describe as very humiliating conditions. Matunjwa has accepted that the strike will end on exactly the same conditions as was agreed with the other unions way back in November last year. So that this 4 or 5 month strike is basically been for nothing. The only thing they've got out of it is 4,000 Rand per striking worker. That's all. That's all that Sibanye gave them. But the strike cost Sibanye 2.2 billion Rand, and it cost the strikers 800 million Rand. So that's a very significant number, and it's caused a lot of anguish and poverty, and it's damaged the reputation of AMCU, and particularly of Joseph Matunjwa. And that will be very important when we go into the platinum negotiations, which are starting now for the platinum mines, where AMCU has a much bigger representation than in the gold mines. I think Matunjwa is going to be weak in those negotiations, because he's weakened by what has happened here in the gold industry. So that's one commodity. And then I mentioned earlier the oil price, which is going up quite nicely. I'll just go back and take another look at that chart for you. North Sea Brent oil, as you can see, since the beginning of this year, it's been trending up very steadily. The oil price has risen from where it was at the beginning of this year, around $50 a barrel, and it's now about $72, $73 a barrel. It's gone up nearly 50%. And that, of course, is a direct reflection of the recovery in the world economy. The world economy is moving forward very quickly now. Europe is growing quite strongly. The Chinese economy is doing okay, and America, of course, is going through a hell of a boom. And this type of rise in economic activity results in more AB income group people, more motor cars are being sold, more trucks are needed to transport products, and the result of that is more oil is being used. And that is causing the oil price to rise. The negative part of that for South Africans, of course, is that the petrol price is going up by 54 cents on the 1st of May. And that might even have a marginal impact on the election, although I don't think so, really. Okay, let's look at some companies now. I just want to spend a little bit of time talking about the JSE overall index and the property market. Now, you may know that the JSE overall index has gone up by 15.5% this year so far. That's pretty good. That's pretty good. Shows that our shares are on their way up. But I want to alert you to the fact that that is mainly caused by four companies which have massive overseas interests: Naspers, BHP, Richmond, and Anglo American. Those four companies. If you take those out of the JSE overall index, it's up just 3%. So the other 12.5% that the JSE overall index has gone up is entirely due to those four international operators. So the JSE overall index has gone up, but not by that much. And part of the JSE overall index is the JSE SAPI, the property index. So let's just take a look at that. It's called the SAP, the SAPY, the SAPI index. And this is an index of the property shares on the JSE. I'm just going to put a bit more data on the screen. What I wanted to show you is 2018, which I've identified with this downward trend line. So that's the end of 2018, that's the beginning. During 2018, the property index in South Africa lost 25% of its value. 25%. Most of that was due to the calamity of the resilient group of companies, because they were accused of manipulating their share prices and their cross-shareholdings and so forth. And there are various investigations which are currently going on into that issue. But this may be an opportunity for private investors, because now the property index is down at record low levels. And in fact, the dividend yield I was noticing this morning is on 8.93%, which is very high. You've got to remember that these companies own the best properties in South Africa, everything from the Cape Town waterfront through to properties in Poland and Spain and the UK. They own very, very good properties. In fact, their properties together, the combined value of the properties which are owned by the SAPY is about 600 billion rand. And if you look at the chart here, you'll see that the market cap of the SAPY is just 4.1 billion. So you can buy 600 billion rands worth of assets for 4.1 billion. That looks like quite a good deal. That looks like quite a good deal. I would suggest that what we're seeing here is a very cogent double bottom in the chart here, and the market is rising off that double bottom. And I think you should be looking at property shares if you're a private investor, because you're going to get them at rock bottom prices. Okay, then the next company I just want to touch on is AO. This is one of the JSE's basket cases. You can see it here. Just take the volume off there. It's almost never traded. Whenever you see this sort of boxy looking chart, I call it a Lego block chart, then you know that there's very, very little trade. Many days there's no shares change hands at all. So it's not a practical share from a private investor's point of view. This company was spun out of AEEI. Let me just put a bit, yeah, it was spun out on the 21st of December. And it has fallen ever since, basically. So the big news about this, of course, is that the Public Investment Corporation, the PIC, invested 4.3 billion rand to buy 29% of AO Technologies. 4.3 billion rand, and they did that because it was something that Dan Machila did when he was still the president of the PIC, and he is known to be a big friend of Iqbal Survey and his family, and they of course control AEEI and this company, AO Technologies. So they put in 4.3 billion to buy a company which has got a market capitalization of 1.3 billion. And they only got 29% for 4.3 billion. You don't have to be a rocket scientist to see that they were charged way, way too much for this share. And that market cap is based on an extremely thinly traded share. If it was heavily traded, we could say it was worth that, but we can't actually say it's worth that at all. So in my opinion, this represents another blatant example of state capture, where a government official has been influenced to put money from the pension fund, from the government employees' pension fund, into a share at a value which is way, way over the top. I know that there are various investigations going into this, but I'm just drawing your attention. Anything that survey family gets involved in, so I'm including companies like AEEI and others that they may list in the future, you want to stay away from that, in my opinion. Okay, now let's look at some better news. Telkom. A little while ago, on the 20th of January, over here, I wrote an article about Telkom, and I suggested to you that Telkom represented a raging buy. And the reason for that is that Telkom was in the process of spinning out its property company called Gyro. And the estimate was that Gyro was worth about 45 Rand a share, and that was not taken into account in the price here. As you can see, when the article was written, Telkom was trading for 64 Rand. Since then, of course, the institutions have got a hold of this idea, and the share is now trading for 84 Rand. So it's gone up 20 Rand a share, more than 25% in 3 months. So I hope you took advantage of that article and bought yourself some Telkom shares, because if you did, you made a nice piece of change. Okay, and then I just want to draw your attention to the Pick and Pay results, which came out yesterday. Very good results, excellent results. For the 52 weeks to the 24th of February, their turnover was up 7.1%. And of course, you've got to see this in the context of a very depressed South African economy and very low South African consumer spending. But they got their turnover up 7.1%, and their same-store sales up 4.8%. They also did a very good job with their working capital management, and by doing that they released 665 million rand of capital which was tied up in working capital, and that brought their interest bill down by 38.5%. This must be compared, of course, with Shoprite, which has had a torrid year, a terrible year, and Pick n Pay has actually been taking market share away from the other companies. They've been taking market share away from Shoprite, from Woolworths, and even from Spar. So they're doing extremely well, and of course this is all due to the work that has been done by Richard Brasher and his team. They've been doing it for 6 years, and that work is starting to pay off. We regard this share now as cheap here on a price earnings ratio of 20. We think it's cheap at these levels, and that it will perform very well in the future. Okay, and then I'd like to draw your attention to PSG, which also produced good results the other day. PSG, of course, is a holding company. They're an investment holding company. Let's go to a candlestick chart here, and I just put a bit more data on the screen. Let's put 2 years on. You can see that the share has been rising very strongly, and this is on the back of some good results. If we put 10 years data on the screen, you can see that this share is basically what we call a diagonal. It's been going up over the last 10 years. It goes from the bottom left-hand corner of your screen to the top right-hand corner. But for the last 2.5 years, it's been drifting sideways. Now, you mustn't forget that PSG owns some very nice pieces of business. For example, it owns 30.7% of Capitec. It owns 55.4% of Curro. It owns 60.6% of PSG Consult and 43.7% of Zeta. So it's a conglomerate of companies, but it's extremely well managed and very strong balance sheet, very good capitalization. In their latest results for the year to the end of February this year, their sum of the parts valuation went up by 22%, and their recurring earnings were up by 9%. So they've been moving sideways for 2.5 years. And if they break to the upside, we believe that they will move up very, very strongly indeed. So this is a share which you've got to watch closely, and you may decide that you want to invest in it. And then finally, I want to talk about CMH, Consolidated Motor Holdings. This is a company which runs motor car dealerships. And the reason I'm interested in this company is because technically it's been in a bit of a downtrend, as you see here, which reflects the impact of the weakening economy on motor car sales. But this company runs all sorts of dealerships: Nissan, Toyota, Volvo, Opel, Ford, Mazda, Isuzu, and so on. Its headline earnings per share for the year to 28th February were down by 8.3% off an increase in turnover of 5.5%. That is obviously because they have been discounting like hell to keep their market share and to keep their sales going. But they've got a very strong balance sheet with cash resources of 676 million rand. And as you can see from the chart here, they've just broken up from what we call an island formation. So they've been an island formation for nearly 3 months, and here we've got an upside breakout. And that's something that, as a private investor, you need to pay attention to. This is a company that will obviously benefit from any improvement in the political and economic situation. So after the election, when people have got maybe more confidence in the South African economy and their future, you can expect them to buy motor cars. That's what they do. When they're feeling scared and they don't know what's going to happen, they put off the decision to buy a big ticket item like a motor car. And they say, look, we'll repair the old one and keep it going for another year until things get better. But once that election is behind us, I believe that motor car sales will start to improve. Ladies and gentlemen, that's all I have for you today, and I hope that you found something of interest there. Do bear in mind that the notes will be published on the website today, and you can go and read through them. There's an awful lot more in the notes than I've been able to cover here. Otherwise, I'll see you on the first Wednesday of June. Thank you for listening to me.